Hello and welcome. This is Islam Ahmed. I will be your lecturer today. Welcome to this online webinar. This webinar will be in English and will have Arabic caption. If we have Arabian attendees who need some explanation, I can give a very brief translation to the information, but mainly this will be in English. So the caption will also have Arabic. Today in our webinar, we will start right now with the risk warning. Please read this carefully. Okay, so please confirm if you can see in your screen the risk warning. The risk warning indicate that trading in Forex, CFDs, and other derivatives is highly speculative and carries a high level of risk. It's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. We will have the same risk warning in Arabic. Okay, I believe that everyone now have read the risk warning, so let's move on. Welcome to this online English webinar with the Arabic caption. The main topic we will speak about today will be risk management, the real secret to successful trading. So risk management, this will be our subject today. This is, as we believe, will be the real secret. If you have successful trading, this will be the main core reason you are successful in your trading. So what's the importance of risk management? This is the first thing we should speak about and indicate. The importance of risk management came from a simple and very clear information that any experienced trader or a new trader will know. You cannot control the market. Okay, this simple sentence is the first thing you have to know, and you have to believe, you have to write it in silver in your room, because this is the truth. You cannot control the market, and you cannot know 100% for sure where the market is going. Nobody can. No one know for sure, for 100% where the market is going. So from this basic understanding that you cannot control the market and you cannot control where is the direction of the prices, you cannot know 100% where the market is going. From this understanding, you will start to apply the risk management techniques, because you can control your risk. So there is two parts in the trading day. There is something you cannot control, and there is something you can control. The thing you cannot control is prices, is market, and the thing you can control is your risk. From this point, we have to, understand the importance of risk management. So, what happens if you don't apply risk management? You simply will lose everything, because in this market, and as we have read in the risk warning at the beginning of this lecture, you may lose all your capital. So after what you heard until now, you understand that you can lose everything. You might end up losing your whole account just because you didn't apply risk management principles. And it's very simple, it's very clear. We will explain it now. It's very simple, and it will protect your account and make your life much, much easier. So if risk management is that important, why don't most people apply risk management principles to their trading? There is two reasons. The first reason is fear. And the second reason is greed. People usually fear of losing. That's why they don't put a stop loss And when they win, they become greedy and they don't take some profit of their trade. So now we have understood the importance of risk management, and we know if we didn't apply these principles, what will happen? We will lose everything. So now we will need a risk management plan. Let's start with this plan. The first step in your risk management plan is to determine how much risk can you handle. Please, if at any point you didn't hear me clearly or didn't see my screen or have any question, feel free to send me on the chat. So let's continue. The first step in your risk management plan is to determine how much risk you can handle, how much risk you can take in your whole account. Based on that, you determine how much risk you can handle per month, per week, and per day. So you only use extra money for trading. Do not trade with money you cannot afford to lose. Let me repeat this sentence because it's very, very important. Don't ever trade with money you cannot afford to lose, because any money you trade with, there is a probability you will lose it. There is 50% chance that you might lose this amount. So please don't trade with money you cannot afford to lose. And there is an advice that says if you have saving or extra money, you want to trade, okay? You want to make some profit from this extra money or this saving. Okay, that's fine. You don't trade with the whole money. You divide it by 3 and only risk third of your extra money in trading. So if you apply this advice, even if you lose your whole account, it will be just a part of your extra money. So this is the first thing you have to do in your risk management plan. You determine how much risk can you handle in total. So the second principle you need to apply in your risk management plan is to determine how much risk you can handle in this trade. You want to take this trade, okay? At each and every trade, you feel that you know where the market is going. You are sure to win this. So ask yourself before you place it, if you were wrong, how much are you ready to lose from your account? Okay, and make this a percentage. For example, I will only lose 2% of my account if that trade goes against me. Okay, so this is the second step in your trading plan. I will, at the end of this steps, make all the steps in one screen. Okay, so keep with me to the third step. So based on what we have determined, you will make a stop loss and take profit and volume for each trade. So for example, if I'm willing to risk 2% of my account on a euro dollar trade. So for example, let's say the account has $2,000 and my stop loss is 40 bips. Okay. After we finish this, I will apply this in a real time example. Okay, so just keep with me in this example, and then we will apply it at the end on the real market. In this example, an account has $2,000. This is my account. I only want to trade the euro dollar for 2% risk, and I have a stop loss of 40 bips. So the 2% should be $40. So if my stop loss is 40 pips and my risk is $40, so the volume should be 0.1, a mini lot, 0.1, which make 1 pip equal to $1. So if this is my stop loss, around 40 pips and $40, so where should the take profit be? This is the fourth step in my risk management plan. You don't make the risk to reward ratio less than 2 to 1. This means if I'm willing to risk 1, I'm trying to get 2 in profit. If I'm willing to risk 40 pips, I'm willing to get at least 80 pips in profit. This is the meaning of risk to reward ratio, 2 to 1. So when you make the risk to reward ratio, you will not need to win every trade to make profit. Because if you apply this principle and you have like placed 10 trades and you lose half of them, at the end you will still be making money, because when you lose only one, and when you win two. When you lose, for this example, it will be like 40 bips. If you win, it will be 80 bips. So if you keep this ratio 2 to 1, you will not need to win every and each trade. And as we mentioned in the first slide in this lecture, you're never gonna win every trade. Even if you did, you wouldn't know for sure 100% where the market is going. So in every trade, you have this percentage, 50% of the time you might go wrong. So you have to calculate your risk before the trade. So now we will go to the fifth step in our risk management plan. You have to take some profit, or at least decrease your stop loss whenever you can. Okay, if we have this example we mentioned, if you have 40 pips of a stop loss and 80 pips of a take profit, so you place this trade. For example, you made the euro dollar buy. Okay, so the market goes your way 40 bips. Okay, keep in mind that our target is 80 bips, 80. Now the market goes our way 40 bips. So we can move the stop loss to the entry point, or even few pips above it. That way, if the market change direction, we will not lose, because after this 40 pips move, even if the market reverse, go back to our entry point, we will just go from this trade with zero loss, or even some points, some winning points. You got this point? Let's review all the steps, all the plan in one slide. It's 5 steps. It's very easy. It's very simple. Keep it in your mind always. First of all, you determine how much risk you can take for your whole account. From this number, you divide it to be like your monthly, your weekly, your daily risk. The second thing is to determine how much risk you can handle per trade. The third is, based on that, you will make your stop loss and take profit for each and every trade. And the fourth step is not to make a risk to reward ratio less than 2 to 1. Then at the last step, we take some profit or decrease our stop loss whenever we can. This is very simple, and now we can apply this to our trading. Before I go to the example, if there is any question, feel free to ask me now before I apply on a real-time example. You can send me on chat if you want, or if you have any question, just send me. Okay. We will go now to the market. Please confirm if you can see my screen, if you can see the MT4, the MetaTrader 4. Okay. So now we have a chart of the euro dollar. This is a 30 minutes chart, meaning each candle represent 30 minutes. Okay, let's go to 5 minutes chart. We will now apply the same principles we speak about. First of all, the amount in this account should have applied the first principle we speak about. If this account, for example, has $5,000, this means this amount of money I have in my account, this is a money I can afford to lose. I have more money than this. This is not my whole money. Okay, this is the classic mistake a lot of traders, I will not say all, but a lot of traders make when they start learning about trading. They put all their money in one account. Even sometimes they get loans from banks, or sell their saving their gold to make everything in this account, in this trading account. This is a mistake. Don't ever do this. As I told you, if you have savings, if you have extra money, if you have a money you can afford to lose, divide it at least by 3 and only trade with third of this amount. So for example, now we have this around $5,000 account, and now we are willing to trade. We know the direction. We think we know the direction. And as we mentioned, nobody know for 100% sure where the direction of the market, but we have expectations. We know from our technical analysis or fundamental analysis or a signal from a website or a friend. We know that, for example, we will buy the euro dollar. Let's buy it. Okay, this account has a $5,000 roughly. Let's say $5,000, and we want risk, for example, only 1%. 1% of this account. 1% will equal $50. Okay, and let's say we will make the stop loss around, let's say 50 pips. So we will only make it a mini lot like this, and we will click buy. Now we entered our trade with the risk management techniques we just explained. So if the market go in our way, we should have this as a winning trade. We should now put the stop loss 50 pips under. For example, this will be our stop loss, and let's say should be 7, 5 like this, and our take profit should be also as we mentioned above 80 pips. Okay. Okay, so the take profit should be up 100 pips like this, and the take profit should be 50 pips like this. Okay, this should be the trade we make. We have a stop loss in this point around 10750, and a take profit at this level around 1090. If the euro dollar go to our direction, we will win $100. If we lose this trade, we will lose $50. What's the percentage of $50 against our account? It will be 1%. Okay, if I'm placing one trade per day, for example, one trade per day, so 5 trades per week, because the market is not working in Sunday and Monday, and Saturday and Sunday, sorry. So 5 trades per week, 20 trades per month. If we made 20 trades like this one, if we applied the same principles, and we were wrong half of the time, so in 10 trades we lost. The loss of this 10 trade will equal to $500. If we win in the other 10 trades, each trade will win $100. If we apply the same principle, we will get around $1,000. So the equation, at least at the end of this month, will be $500 of a winning profit. That's only because we applied the risk management techniques we spoke about. If you notice that in all these scenarios, we didn't speak about technical analysis or fundamental analysis. We didn't say why we bought or sold this euro dollar, why we entered these trades. We only speaking about calculating our risk. We speak about controlling the only thing we can control. If you recall what we spoke about at the beginning of this lecture, we cannot control the market. We cannot guarantee and know for sure where the market is going, where the prices are going. But the only thing we know for sure we can control is our risk. So we are just trying to control the thing we can control. So if we control our risk, let's speak about the worst case scenario. Worst case scenario. If I entered this 20 trades and I lost all of them, how much would I lose? If I lose only 1% per trade and I lost 20 trades, this is a whole month of losing. I have never met a trader, any trader, new or experienced, who lose every trade in months. Even if he blow the account, even if he loses his money, at most of the time, he at least have some winning trades. So the worst case scenario that have never happened, let's say it happened for some person, that this person is applying the risk management principles we spoke about. He would only lose 20% of his account after a whole month of losing trades, because in each trade he only give the market 1%. The stop loss is only 1%. So after a whole month of losing trades, 20 trades, he'd never know where the market is going. He never hit it. He always lose. At the end of this month, he will only lose 20% of his account. If you are experiencing trading, if you already have real account, you know that 20% is not a very big amount. Most people actually lose the whole account in this first month. Okay, so that's why we speak about this risk management techniques and principles and say this is even more important than your technical analysis. This is more important than your fundamental analysis. This is the real secret. The most important thing you would do in your account is to control your risk, is to apply these principles. When you apply risk management techniques, as we say, you will avoid to blow your account. You will live to trade another day. And if you are willing to have profit, to make profit in this market, you need to stay for a long time, because this is a long game. This is not a short game. This is not like a hit and run. You need to stay for a long time in the market to learn, to see, and you will find chances to make great profits. But it's like a marathon. It's not like a very fast 100-meter running race. This is a marathon. This is long run. So you need to be patient and you need to control your risk. Okay, let's just for the sake of this example, let's see this trade. For example, if it move in our way as we spoke, actually it's in the same point, but let's say if it move our way, we can move this stop loss. Now our stop loss is 50 pips away, which equals to $50. Let's say the market goes our direction. We can move this like this. If you did this, you decreased your risk by 50%, by 25 pips. Now your stop loss is 25 pips away, which equal to 0.5% of your account, half percent. This is less than 1%. So you only do this if the market goes in your way or you think that you need to protect your trade. Personally, I can do this only when the trade goes to my direction at least half the way. So if my target is like 100 pips, I can only move my stop loss to entry point after like 50 pips. In some cases, even after 25 pips, I can move my stop loss if the market is moving fast and I'm not sure where this will go. Maybe there is some news. So I can move my stop loss to the entry point after 25 minutes. Sorry, after 25 pips. Okay, if the other direction happened, if this was my stop loss here and the market is going against me, I will not move my stop loss. I will just keep it, because if I kept moving my stop loss when the market goes against me, I will never have a profit trade. because at every trade you will have a chance that the market goes for some time in the other direction, then it goes back to the direction you predicted in the first place. So we have to wait. And if we accepted this stop loss, we accepted this risk, we should leave it on the table. We should leave it to the market, okay? Actually, the best practice is to put your stop loss and take profit and then just leave. Close the screen if you can. Leave the MetaTrader. You already know, you already did your homework. You already placed your trade. You already do your analysis. You know what you are doing. You know this trade should go in this direction. You finished your work. Now let the market do his work. You cannot, let me repeat it for the fifth time. You cannot control the prices. You cannot control the market. You cannot command the price to go in your direction. You just predict the prices. So if this goes in your direction, it will be profitable trade. If it didn't go, just accept the loss. You give the market 0.5% or 1%, just accept it and leave it on the table. Okay, so this was a live example. So please, if there is any question, if there is something not clear, if you have any comments, feel free to write it now.